name is Ryan Trainer, and I'm president of the Redwood City Literacy Council, the volunteer group that is putting on these classes. We are sponsored by the Redwood City Library Foundation, and this class is the fifth in a series of 9 classes that change the theme each month. This month is about savings, investing, and building wealth. You should learn a lot today about the different types of investments and how to pick the best investments for the risk you want. Next month is about types of credit, so don't miss that one. Make sure you sign in and sign the desk if you haven't already, because we need the records for various things. You should have some handouts on your chair. The top sheet is your pre-test. You should fill this out now. There are also some sheets that we may refer to in class, used as activities, or you can make them as supplemental material after today. So please take them home with you. When you're done with your session 5 pre-assessment, pass it to the aisle for us to pick up. Please take the time now to complete this, as we might want you to remember to attend. Now, let me introduce you to Ryan Trainer, my mom, financial expert. She's going to be leading the class today.
Unless her mom is just and then hold with her. Anyway, today is about savings, investing, and building wealth. Does anyone know the difference between saving and investing?
Well, saving is like having the money and not spending it, and investing is spending it on something that will increase your return.
Exactly. He said savings is taking your money and setting it aside to spend later, and investing is buying something now that you think will increase in value so you can sell it later for a profit, and then you can buy something else. So both of them have something in common though, right? They make a return, so you want to get a profit on your money. So the difference is investing, that sort of asset appreciates in value. Does anyone know what appreciate means? Yeah. Right. So even though you're not buying or selling something, just by sitting there, it gets more valuable over time. So that's the difference between savings and investing. So you calculate the return on investment when you sell it down the line. Whereas with savings, you can figure out what your return is essentially almost every day, right? Because you know what your interest rate is. So there's some risk involved in investments because you don't know on a particular moment what you might be able to sell that asset at. So that's the difference between saving and investing. So building wealth is when you actually sell those things or cash them in, and then you get the original value back, the principal amount plus the accumulated interest or appreciation of value. Okay? So there's some reasons why you should save and invest, right? We had talked a while ago about paying yourself first. Does anyone want to share what that was about? I know we have some new people in the audience today. By the way, there's a bunch of people not here because there's a major flu going through the schools. You probably noticed a bunch of people are sick. So just be careful about sharing plates of food or whatever, because there's something definitely going through the schools. So as far as paying yourself first, what does that mean? It means that when you get your paycheck, instead of thinking immediately, oh, I can go down to the mall and buy something, you should say, the first thing I do from every single paycheck is I pay myself first. So I'll take a certain percentage of that money and set it aside. Put it in savings or buy an investment. So you should start now thinking, pay myself first, and think of what percentage you want to set aside for the future. And so you want to make it a habit. You set aside your extra money. And an important thing too is not only savings and investing, but by paying your bills on time, you will not be paying late fees, additional interest, and hurting your credit so that you have higher cost of credit later on as well. So we'll talk about that a little bit more in our next session about credit, but savings, you can put aside more savings by paying your bills on time. Okay? Now, investing, it seems pretty simplistic, but you buy when you think it's low, and then you hope to sell when something's high. But it's not always as easy to do that, especially when you're looking at stocks. So that's why it's really important for you to be reading the newspaper, watching the news, because you will start to hear about trends that are happening in certain industries. For instance, the introduction of the Apple Watch. What does anyone think that might do to certain industries? What industries would be affected by the introduction of the Apple Watch, which is happening right now? Yeah. Yeah, regular watches, but they're already pretty much impacted right now, right? By the iPads, the iPhones, etc. So, yeah.
It would bump Apple stock, if all would decrease Samsung and.
Exactly. Now, what happens when you do a new, he said it will increase the price of Apple stock, and it will decrease the price of their competitors, because they have a unique, interesting product that no one else has. Now, when it gets released, what you're going to see, and some of you might have seen this for some of the video games that have come out or whatever, there's a bunch of hype right before something is released, right? And there's already talk on the market about, will the Apple Watch work, will it not work? And so you'll hear things like, no one will buy it because the little dots on there are too small. There's already some talk about the negative things about it, which of course their competitors want to promote, because they want to promote their products. So that's why you need to listen to the news and read the newspapers, because if you're interested in buying any related stocks to watches or handheld devices, that release is going to have a major impact on the market. Now, you'll notice if you look at the trend of Apple right now, with that being released over the next week or so, there's anticipation in the market, so the price has already started to go up. So if it gets released and there's a computer glitch, this happens a lot with video games, by the way, if they come out and there's something wrong with them, what happens? The stock dips. It's almost an immediate reaction, so that's why it's pretty cool to watch the stock market, because as soon as something is identified, it will impact the price of the shares. So that's pretty cool. So investing, of course, involves higher risk. And why is that? Why do you think investing involves higher risk? Yeah.
Because sometimes it doesn't work, and the stock goes down, and you lose money.
Right. So can you really predict when you're investing what your return's going to be? Only if you invest in a certain thing like a bond instrument, which is really considered a savings type investment. So I'll talk about that in a minute. But if you're investing in something that's called an investment, which is a different bucket, then there's a lot of unpredictability. You don't know if inflation's going to impact the price of the stock. Maybe there's a foreign company overseas that's going to copy, say, the Apple Watch real quickly, and then that'll impact it. So there's a lot of factors that impact investments that don't necessarily impact savings. So what does that cause to happen to investments, the rate of return? It goes up, right? The more risk, the higher your return will be. So you'll see there's some stocks out there, as an example. Utility is known for this. They offer very, very steady returns. They'll give very set dividends every single time because the rates that they charge their customers are regulated by the government. So utility stocks won't have that big of a return. because they guarantee, or pretty much guarantee, a certain rate of return on that investment. So even within stocks, you'll see the higher risk industries will get the higher returns. So you might have heard of an IPO. Does anyone know what an IPO is? Living in Silicon Valley, this is really important. Yeah,
The initial public offering?
right. The initial public offering. And do you happen to know what that is?
So that's made after the company's already gone to investors. They will open the company up, start selling shares, and will open the public market.
Right. So the company probably has been in business for a little bit to establish itself, but not for very long. So they have been able to get marketing material out to investors, mutual funds, et cetera. There's some underwriters that do this, insurance companies, et cetera. And they will release the initial public offering of that stock on like the New York Stock Exchange or the NASDAQ. So you've probably heard of a lot of people when the internet bubble happened. All of that happened because of IPOs. Does anyone know what happened with the IPOs? There were the initial internet-related stocks or computer chip-related stocks went way up because the public thought, wow, this is going to be the way of the future. I really want to get in on the ground floor. And so those people made a ton of money on the IPOs. And you'll see an IPO will be released, and initially the stock price will go way up because there's a lot of demand, and then it'll drop back down. So IPOs are important, especially here in Silicon Valley, because we have a lot of venture capitalists here that invest money in new companies. And the way they get their money back out of those companies is by issuing these IPOs and exchanging stock for their money that they put into. Okay? So, savings accounts. They do have benefits. Go very low risk. The original investment grows with a very set amount of interest. And you can use that as, okay, I'm not making much money, but I know that's my account to buy Christmas presents, or that's my account to put a down payment on my car in a year, or something like that. So it helps you plan for future investments. And it also helps you achieve major life goals. For instance, if you want to go into college, you're going to need to put some money aside for books and tuition payments, etc. So as that grows, it will actually keep you motivated to meet those goals. So the disadvantages are, because it's pretty calculable how much interest you're going to get and what the gains are going to be, it'll be low returns. So especially when you're younger, you may decide, well, I don't really care that much. I'm gung-ho about being risky, so you'll go ahead and invest in pretty risky assets. Whereas when you're older and you're going to depend on that nest egg of investments for your retirement money, instead of working and getting a paycheck, you may switch your investments then from higher risk type of investments into lower risk type of investments. So, compound interest. How many people know what compound interest is? I'm not going to ask you just to raise it. I know you're trained to raise your hand. Okay. This is pretty important because some savings accounts and investments offer compounding at a different rate. So for instance, compounding, and I'll show you a quick video, maybe I should start with that, and then I'll explain what APY is, okay?
interest and a lot of time, compound interest can work miracles. In fact, compound interest may be considered one of the most powerful concepts in finance. Compound interest is reinvesting earned interest back into the principal of an investment. Earning interest on top of interest increases the principal, resulting in exponential growth over time. Exponential growth is the acceleration of growth in an investment's principal. Exponential growth is the result of letting interest compound over time. This idea can be a little abstract, so let's look at a hypothetical scenario to better understand the power of compound interest. Suppose there are two investors who have a starting balance of $10,000 each. They both decide to buy the exact same investment on the same date, and they both plan to hold their investments for 30 years. But one investor plans to withdraw the interest at the end of each year, while the other plans to reinvest the interest and let it compound. Let's fast forward 30 years to see the difference in potential returns. In this example, let's suppose that the investment earned 5% per year. The investor withdrawing interest every year would have earned $500 per year. Over 30 years, the earnings would have totaled $15,000. That's not too shabby. But let's see how much of a difference reinvesting the interest could have made. The investor who reinvested the interest would have possibly earned $33,219. This is more than double the return of the other investor. This is the power of compound interest. Now, let's take it to another level and discuss the importance of time. Compounding over a long period of time can potentially lead to exponential growth of a portfolio. Let's look at another example to understand how important time is to compounding. Suppose two investors have portfolios worth $100,000 each. The portfolios hold similar investments. They both use compounding to grow their portfolios 6% per year. One investor needs the money to retire in 20 years. The other will need the money to retire in 40 years. Let's see what a difference 20 years can make. At the end of 20 years, the $100,000 principal would have grown to $320,713. Now let's see how much the other investor would have earned. As you can see, the additional 20 years of compounding resulted in the principal growing to $1,028,571. That's more than 3 times the return of the other investor. Now that you understand how time impacts growth, let's discuss 3 ways how you can harness the power of compounding. The first step, and perhaps one of the most important, is to start investing early. The earlier you start, the sooner you can gain the advantage of time. The next step is reinvesting earnings. When it comes to investing, earnings are typically in the form of capital gains and dividends. Some brokers may allow you to automatically reinvest earnings, or you can simply buy more investments with earnings from capital gains and dividends. The final step is to avoid possibly the biggest obstacle many investors face, which is taking excessive risks that can lead to large losses. After all, compounding only works if you're earning on your investments. Of course, always earning a profit is easier said than done, because investments sometimes make money and other times lose money, particularly stock investments. You can't guarantee your investments will make money every year, but you can avoid taking excessive risks that can lead to large losses. Large losses can potentially be reduced by allocating your portfolio across different asset classes, such as stocks, bonds, commodities, and currencies, and diversifying your portfolio within each asset class. To help reduce large losses, resist the temptation of taking excessive risks in the hopes of earning fast money. Because when it comes to harnessing the power of compound interest, slow and steady is a better approach.
Okay, so compound interest, this is an example, which I think is pretty telling, and also in your,
If you take a look at this 40-year run on the dollar is designed economically to lose money every single year.
okay. I put this up here because I think it's pretty important that you guys know, the earlier you start investing, the better it's going to be for you, okay? So you'll see here on the left side They both invested exactly the same amount of money. The first person invested $2,500 a year starting when they were 21. And then just kept it earning interest after they were 30. And the next person started investing when they were 45, the same amount of money, and ended when they were 54. But you can see when they retire, there's a huge difference. It's $91,000 because that person started later versus $578,000 because the other person started early. So if there's one thing you can take home today, is I know it's hard to put away, pay yourself first, right? But this really shows you how that can make a big, big difference in the amount of money you have when you retire later on. Just make a point to put it aside as early as you can. So, you'll see in your packet, there's another example of that, the advantage of starting early. I won't go into it. This one's a little more complicated, so you might want to look at it. And this one is talking about how you would have to make it up by investing a lot more money later on if you didn't start early. So, based upon my talk about what is an investment and what is savings, which of these items is not considered an investment? This was on your pre-test. Would it be real estate? Would it be a checking account? Would it be collectibles like Yu-Gi-Oh cards or baseball memorabilia, that sort of thing? Bonds or mutual funds? Does anyone want to? Yeah, it would be checking account, and the reason for that is because you don't earn any return. So it's not really a savings or an investment. Because you can take it out at any time and you're not earning a return on it. So, when should you never invest money? Before we get into investments, I wanted to make this clear. You should never invest money that you can't afford to lose. Because that's considered gambling, right? And you've heard a lot about people that gamble and then they get into real big problems later on. So just make sure that when you're setting that money aside, you're not taking away from something that you're really going to need later on, like say gas money for your car or your tuition payment for school. Okay. So let's say you have a savings account that compounds monthly and another investment that compounds annually. That's when the only way, besides doing a lot on your calculator, to figure out whether those yields are the same is you'll see when you go into a bank, they'll have this CD is this APY, this investment is APY, this amount. That's an annual percentage yield. That has taken all the different types of compounding and put it into one number so you can compare this CD that compounds annually and this CD that compounds monthly. So that's really important. And that was put into place by the federal government because they found that some financial institutions were using those sorts of different methods of compounding to kind of trick people into investing their money in something that in fact was paying a lower yield than something else. So look for the APY. Okay? So your compound interest will grow, and it's all of these things. You know, if you invest more money sooner, it will grow. If you hold it for a longer period of time, it will grow. If you reinvest all the interest received, and also if you increase the amount you invest per month, that will make your interest grow over time. All right, any questions about that? Okay. certain amount of interest rate, which is kind of low, but you can take out your money anytime you want. So if you want flexibility, if you need money to go to the movies next month, then you're going to put your money in the savings account. CDs are letters that describe certificates of deposit. Those are still low risk because they're typically guaranteed by the federal government, so even if the bank goes under, you still get your money. So it's low risk, and you can open them for as little as $1,000. Sometimes they'll offer specials for students, so you can actually buy something even lower than that. But you can't touch your money for a certain period of time. So you'll buy a CD, and it'll be a 3-year yield, it'll be a 5-year yield, etc. So, interest rates are really low right now, so something weird happens when that happens. Sometimes, usually, if you invest money for a longer period of time, what happens to the interest they're willing to pay you? It goes up, right? Good. Because you're putting that money away for a certain period of time. But our interest rates are so low that sometimes they want to pay you that 2%, 3% for as long as they can get you roped in for, right? So they'll want you to invest longer term. So even if you go out higher, they'll try to keep the interest rate low. But as interest rates go up higher, and they think the interest rates are going to dip down low, it may slip. So again, keep involved with listening to the news, the newspapers, figure out what the economy is doing, about inflation, because all those things do impact the rate of return on your investments. Okay? So, money market deposit accounts, it's a form of a savings account. It does require a larger balance of $10,000 or more typically. It's a better interest rate, but again, it's a savings vehicle. These three are savings vehicles, and because of that, you have more flexibility. Now, before we go into the next section where this is about investment vehicles, I want you all to take a couple minutes in your packet. You'll see a little questionnaire I want you guys to fill out. It's called Risk Tolerance Quiz. Now, this is something where you don't just take it once in your life and that's how risk tolerance is going to be. Depending on where you stand in your life, like for instance, when you're newly married, your risk tolerance is going to be different. When you have a new baby, your risk tolerance is going to be different. But right now, at your point in time, being in your teens, you're going to have a certain sort of scenario come out. So answer it honestly. You're the one that's just going to be answering it right now. And take a couple minutes, and you may be surprised with how risk tolerant you think you might be. Okay? thought we'd just throw it out to the audience. Was anyone surprised with, when you were faced with different scenarios, with something you took down? Which of those things do you think would change, say, after you were married and you had a baby? Yeah,
I would say like less high risk investments probably.
right,
You want to more stable.
right. Less high-risk investments because you want to depend on that stable income. The other thing that people a lot of times do when they have their first child is they start a college fund for them. Because it does take a while, and if you start your college fund for your baby when they're born, we just went through that, right? What'll happen? Because of compounding, you won't have to put in as much to get a lot more later on. Okay, so the next section is about investments, and again, these are things that you're purchasing, not putting the earned money aside, but you're actually purchasing these things, expecting a return, which can be payments of dividends or the appreciation of the money going up. So, I want to show you this video about stocks, and then we'll talk. I can't remember whether it goes over dividends, so if it doesn't, I'll cover that in a minute, okay?
Learning about investing is a lot like learning to ride a bike. At first, it may look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, you can take the training wheels off and really start riding. Along the way, the road will change. There'll be good days and bad days. While learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments, stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation. When the stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that offers better returns than a savings account. He is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So, how much does a share cost? Suppose the company is valued at $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1,000 of Bull Flag Cycling. Because the company is valued at $1 million, each share would initially be valued at $1,000. Our investor purchases a single share through his online stockbroker for $1,000. Now let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor can now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the price of the stock. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to making money in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments, such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with the increased risk comes the potential for greater returns. Savvy investors take precautions to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets. Now you know some of the basics about investing in stocks. If you're interested in learning more about stocks or other investments, we're here to help. Take control of your financial future today with Premier Education.
Okay, so I think it did cover, what dividends were. Does everyone understand that? So you can make money by the price of the stock going up, but again, you'll only get that when you sell it, which is pretty important. Or you can invest in a company, and what they do with their profits is sometimes they decide, instead of reinvesting those profits back into the company, they'll actually pay those profits out to their stockholders. And that's when you get a dividend. So those little checks off of the profit, which sometimes can be big, right? Especially if it's a risky stock. You have to factor that income as well as the increase in the price of the stock when you're figuring out what your return is. Okay? So the next one is mutual funds. So how do you think mutual funds are different than stocks? Anyone want to, you can probably see it up there, but this is a way to kind of decrease your risk. Because say you're a small investor, you saw in that example that he only bought one share of that stock. If you only have $2,000 to invest, and it went down like that example they showed at the end, that could be really horrible for you, right? So what happens is a bunch of people, say 1,000 people, will decide they want to buy one share in that stock. And so they'll invest in a mutual fund, and that is a company that puts a bunch of different types of stocks, and usually they're grouped by, say, riskiness or types of stock. So you can say, I want a technology mutual fund, or I want a very secure long-term mutual fund, or you can say, I want a growth mutual fund, which means that they're made up of primarily riskier stocks, and they expect the price to go up, but you also have the chance of losing your initial investment. So mutual funds are a way to put a bunch of people's money into a bucket, have someone manage that account, but then your risk is spread over a number of different types of investments. Does that make sense? Okay.
A mutual fund is a collective investment that pools together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can benefit investors in several ways. They are a simple way to make a diversified investment. Most are managed by a financial professional, and because of the wide variety of mutual funds, they allow investors to participate in a wide variety of investments. Let's walk through an example of how a mutual fund works. Suppose there's an investor who wants to invest some of his retirement portfolio in the stock market, but he doesn't have time to analyze individual stocks and create a diversified stock portfolio. Instead, he decides that he'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will in effect be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for him? To find the right one, he uses online tools such as mutual fund searches and ratings given by independent third-party organizations to find a mutual fund that meets his investing goals. Once he finds a fund that looks like a good fit, he reviews the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides a wide variety of information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and other useful information. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So he pays the minimum investment amount and purchases one share of the mutual fund. By owning this share, the investor now participates in the gains and losses of all companies held in the fund. The benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this helps lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small, because that struggling company is only one fraction of the fund's total assets. Like most other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Managers work to provide the biggest returns they can for investors using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns he was hoping for. However, even if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only costs our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. Now that the investor has bought into a fund, how does he make money from it? The first way is through appreciation, which is when the fund's shares go up in value. Typically, when the fund's assets rise in value, the fund's shares do the same. Unlike a stock, the value of a fund's shares does not change throughout the trading day. Instead, the fund's value is calculated and updated when the market closes. The second way to make money through a mutual fund is through a dividend payment, which is when a mutual fund pays out a portion of its earnings to shareholders. However, when the fund's assets fall in value, the fund's shares do the same, which is a risk of owning a mutual fund. One benefit to mutual funds is the variety of mutual funds available. Our investor chose a mutual fund that invested in stocks. However, there's a mutual fund for almost every type of investment. For example, equity funds buy stocks, fixed income funds buy bonds, and balance funds buy both. Some equity mutual funds may invest in a whole index, while some others focus on stocks of a certain country or market sector. Certain funds have different objectives as well. Some may look for riskier stocks in growing industries, while others will invest in more stable companies. There's a lot to learn about mutual funds and other investment options, and we've got the resources to help you get started. If you're interested in learning more about mutual funds or other investments,
and the last type of, there are more vehicles out there, but we don't have enough time to cover them all. These are the major ones. The next one is bonds. So bonds, say you're a corporation, or some of you might have heard about school bonds. Has anyone heard about school bonds? They'll go up for election, right? And so you'll see signs all around town, vote for Measure N or whatever. Those are schools wanting to put out a bond, which is, you give me $1,000, I'll give you a certain rate of return, right? And so schools especially put out bonds because they're limited in what they can borrow under the government. So they'll issue school bonds, and they have to get the people to vote on that they're allowed to issue the bonds. So bonds can be safer than stocks because it's similar. You're putting in your $1,000 and they're giving you an interest rate. However, people may think, well, governments are pretty safe, right? Well, I will tell you, there have been some municipalities that have gone bankrupt. And so those people lost their bond money. For instance, Stockton and Orange County, and even the city of Detroit. And so all those investors that had put their money in the bond lost that money. So it goes back to what they were saying about research, and we're going to have someone talk to you about that in a minute. But whatever you're investing in, you really have to stay on top of the industry and that particular company too. Because say, for instance, I forget who it was, but yesterday somebody, might have been Google, announced that their CEO was retiring. Now, if they don't have someone in place to take over that's as good as that CEO, what will happen to that company's stock? Right, it'll go down. So all of those little news bits, when you have investments, you really need to keep on top of it and say, oh shoot, that guy's retiring. I don't think that they have a good one lined up. We'll give them 5 years to be as good as the other one. So for that period of time, that stock will be depressed because of that new person coming in. On the other hand, you may decide, the market's reacting negatively to that piece of news, but I still think that's a really strong company. So now's the time to buy. Because what happens after he retires? The stock will dip down, and that's when you want to invest. Because you think it's going to go back up after everyone realizes, hey, that guy's pretty good. That replacement. All right? So, corporate bonds, you buy those because you have a set income, it's pretty stable, it pays slightly higher interest rates than what you would get at a bank. But, again, you do have to worry about possibly that government or bond company going bankrupt. And there are corporations as well that issue bonds. And you'll see that they are rated, so you'll be able to tell if this one's AAA rated, then their bonds are stronger than someone that's, say, a single A rated bond. And how are we on? All right. So, you'll see in your packet, I won't go into it now, but there is a sheet that has some stocks that I thought you guys might be interested in. They're typically for younger people. What you can do is, and we're going to talk about an investment club in a minute, but just on your own, pick a stock that you think maybe you buy a lot of the Gap, or you use Google for a lot of things. Then pretend you're buying a share of that stock and then trend it out and figure out what it's doing. And then you'll notice when you own something that the news pieces that come over on the news or the radio or in the newspapers, you'll pick them up because you have a sense of ownership of that. Does anyone want me to go into the bond video, or can I skip that? Is that all right? Okay. The next major bucket is real estate. I know you're too young to talk about this really right now, but eventually you'll come to a point where you're saying, I'm paying $1,200 a month for my apartment. Can I make a return on my investment? Because you have to figure out that you're actually going to make up that difference if you were to buy a house. So it's free buying a house as another major bucket of investments. You're going to have to figure out if it makes sense for you to go from renter to borrower, to purchaser. And you'll notice in some markets right now, Redwood City is crazy inflated. Most of the houses are over $750,000. Other parts of the country, $750,000 would buy you huge mansions. So some people may think, and I'm hoping not, that we're at a real estate bubble. So if you're at the top of that real estate bubble, do you think you should buy right now? No, tell you what. If you're gonna hold that house for 10 years, and you think that bubble might go down in that 10 years, but then it's gonna go back up to that level, it's okay to buy, right? But if you think it's at the top and it's gonna continue to decline until it levels out at a certain point, then you should wait and go ahead and invest in other things that pay you a higher return. So it's not necessary, my father always told me, invest in real estate. That's because in the past, real estate was a very steady appreciation. But in California, that's not the case. We go up and down a lot in real estate. Other parts of the country, they have a very steady incline in the value, which is a good hedge of inflation. Because you know, if you put your money in a mattress, you're actually losing money every day. Because you should be having it in some sort of investment that'll offset inflation. Because how many people think in 5 years your dollar's still going to buy you the same amount of stuff it buys today? So your goal is to offset that inflation rate with a return of some sort. So if inflation is, say, 3% a year, then you want a return higher than that. Otherwise, you're always going to be losing money. Your dollar's going to be going down year after year. Okay? And then other investments. Can I hear if anyone has collectibles out there? I bet you do. Just not thinking about it. How many people have a signed jersey from, say, Jerry Rice or somebody like that, or their parents do? Yeah. How many people, when they were 10, collected Yu-Gi-Oh cards? No one wants to admit that, I know. Now, my son, not Ryan, because he will tell you if I say this, my older son used to collect all of his cards. First it was Pokemon, and then it was Digimon, and then it was Yu-Gi-Oh, and then, you know, now it's Magic cards. And he always says, oh, this card's worth so much money, Mom. Look, I'll show you. And he'll go online and it'll be $25 or whatever. But just like any other investment, like stock or something, is it really worth that today? Right. It's not worth that today. Why is it not worth that today? Because you haven't sold it, right? It's only worth that amount if you sell it. So you always have to keep that in mind. So you shouldn't predict, is my investment worth $25 today? You should say, I'm going to keep that for 3 years. How much is it going to be worth in 3 years? And then predict that and decide, is that something you want to invest your money in or not? There are a lot of collectibles out there. There's things like your parents may have paintings that are investments. They may have collectibles like Yadro figurines or Hummel figures. Your grandmothers probably have those. It could be sports paraphernalia. I mean, a lot of you I know bought championship sweatshirts and things after the teams won. So those things, because of the rarity, later on, you can't find them anymore. They're not being made. They will go up in value. But you have to be willing to sell, and you have to find a buyer. So the problem with collectibles are the markets aren't as fluid as, say, stocks and bonds. So you're going to have to go out there and find the market for that item. Now, it's much better today than it was for me, say, 20 years ago. If you had a collectible, you would sell it in a garage sale and maybe get $1 for it. But now we have much more efficient markets. Can someone tell me what the markets for something like a collectible would be? Yeah.
Well, how you think it is, there are websites for specific things and there's eBay.
Exactly. There are websites now on the internet where you can sell just about anything. I'll give you an example. When my kids were younger, they were really big into Legos, right? And it always would happen is they buy they want a Lego kit that was like only out 10 years ago or something. And then it would arrive and it would be missing a couple pieces. But you can go online and find specific websites that sell one little you know that I sell and buy a lot of things on eBay and make a decent profit on that. So eBay is a way to do it. There are, does anyone know that across the street from the ice cream store, what's the name? Young's Ice Cream, there is a store that sells collectibles. And inside there, he has something that you guys probably don't even know. Matchbox cars from many, many years ago. He has things like the plastic figurines from like Superman, or any collectible toy from, say, he has some things even from like 3 years ago that you may not be able to find in the stores anymore today. And you can actually go in there and negotiate with that guy to sell him your collectibles. All of your old toys that are now worth more in value. Okay? But it's harder than, buying stocks and bonds and things like that, because you have to find that person. Okay, real quickly, because I'm just going to talk about the rule of 72s, and we were going to do an activity, but I know you guys are hungry, and I want to give the woman back there a chance to talk to you about a stock investment club for teens. So the rule of 72s, I noticed someone here in the first row figured it out. Does anyone want to explain what the rule of 72s is? Okay, no one wants to talk about it. This is a way, if you want to say, I want to double my money, and there's two ways to do it by using the number 72. You can double your money by figuring out what interest rate you need to get over a certain period of time, like say, 20 years. Or say you know the term, or it's an interest rate of 4%, how long will it take me to double my money? So it works both ways, and you just do 72 divided by the time, or 72 divided by the interest rate, and again, that's compounded annually. So that'll give you the period of time, the number of years that your investment will double. And that's a handy way to figure out what you want to do. So final guidelines for investing then. We talked about this a lot. Buy low, sell high, right? But what do you have to do to be able to do that? You have to do your research. You have to be tracking the things, sometimes daily, sometimes hourly. You can see on the stock exchange, depending on whether it's near closing time or not, prices of stocks will change. So it's not as easy as it sounds, right? You're going to have to listen to the news, figure out what's happening in the management, research for competition, research the industry. For instance, when there was an oil spill in the ocean, those stocks normally used to be very stable, plummeted because of bad press. That they knew that there were going to be lawsuits involved in that. If you were listening to the news, reading the newspaper, listening to the radio, you would have figured it out and maybe got in to sell your stock before it went to the ground. So that's the key thing, is you have to research. Diversify. There's 3 ways to diversify. That means putting your money in different buckets, right? Spreading it out amongst things. Because say if you invest in, say, Nintendo, you'll want something else that is not in that industry. Because otherwise that's to ensure a steady rate of return. If you don't mind it going up and down, that's fine. Put all your eggs in one basket. But if you want to not have to worry about losing your money, then you should diversify. And then you can do that by the type of investment, so stocks, bonds, savings accounts, real estate, collectibles. Or you can by the size of the company. So for instance, a Google might react differently from a small network company that's in the same industry, because they'll be affected differently. And also the type of industry, so technology versus, say, a municipality. So look at the type of industry. A clothing manufacturer will act very differently to market events. I mean, the one market event was 9/11. That put the whole stock market into havoc because prices were all over the board, because people were looking really fast at how much those companies were invested in America, because they didn't know where the damage would end. So little events like that can dramatically impact your stock investment. Buy and hold. If you invest longer term, it'll be a more stable income. If you invest really short term, not only is it like gambling, but you will crank up a lot of fees by buying and selling things. Decide in advance where you want to sell and where you want to buy. And that includes the low point and the high point. Okay? Because if something happens in the market and the stock starts diving, you may decide, okay, when it hits 10, I'm selling no matter what. Okay? Or same thing, if it keeps going up, you say, okay, when it hits 14, I'm going to put in a sell order and I'm going to sell it there. So look at your floor and your upper amount. And then pay attention to the costs, and that includes your taxes, fees, and inflation, because you'll always want to get a better return than the rate of inflation. So we talked about tracking your investments, and the key thing is sticking with your plan, okay? Because you don't want to be buying and selling a lot because of the transaction fees, and a lot of work goes into researching, etc. So figure out your plan and say, okay, for the first 5 years, I'm okay with investing in risky investments. Then after I graduate from college, I'll kind of tone it down a little bit, that sort of thing. So think now about where your head lies. And you can use that survey that's included in your packet down the road to figure out how you should change your investment strategy. Okay? Okay, Ryan. I'm going to have Ryan invest in the new, or introduce the one here. That's going to just take a couple minutes, and then we're going to break for pizza. Are there any questions before we do this? I know that was a lot. Believe me, I did cover tons of things that are out there. But this gives you the real basic investment things that you should be thinking about, even today. You don't have to just put your money in a savings account.
Okay, so before we wait for pizza, I would like to introduce Joyce Cave, the founder of Foster City Investment Club. After all we learned today, you might be interested in joining her club to learn more about stocks. She has brought a quick review of her 2 favorites, Apple and Twitter. Here's Joyce Cave.
Hi guys, just passing them out. I didn't bring enough. There's so many of you. That's awesome. So how many people have an iPhone? That's why Apple stock has been doing so well. You either have an iPhone, you have an iPod, you have an iPhone, you have whatever else they've got. Now we've got the iWatch coming out. So we look for companies that are growing, that have products that are new, that everybody's excited about, blah, blah, blah. You know, so I've got a list. I just brought 2. I brought Twitter because it's very new. And you're gonna have to share those, by the way. So if you get one of the 3 Chrome ones, share with someone else, because there's a lot of people. I didn't realize how many.
And by the way, I should take this and I'll post it on the website that we have in case anyone wants to download it later, okay?
So Apple would be considered much more stable because it's a longer term. We have 20 years history on it. On the particular value line, these are called value lines. It used to be that this is what the pros used, and you can get it here at the library. I started in the investment clubs in '95, so at that point, you know, we were able to get them and at the library, or you could pay for the service. It's pretty hefty, $600 or $700 fee a year or something. And then we would take all the information that's listed on here. It has earnings per share, it has dividends, it has book value, it has beta, it has so much on this newspaper, which is my favorite newspaper, Investors Business Daily. It's a little different type of stock analysis. This they call fundamentals, because you're going to look at all the data. Investors Business Daily looks at charts. There are people that analyze charts, and it has to do with the fact that we're all humans, and that people tend to react the same way over and over and over. History always repeats itself over and over and over. So these chartists watch stocks and watch the charts, and they believe the charts. They also watch fundamentals, though. They're a serious fundamental as well. They have certain strict guidelines. But anyway, the other little piece is the owner, William O'Neill. It's his philosophy of life, 10 things that you should do in life. It's my favorite thing, so I just brought it to you. You can do whatever. So at the very top, can anybody tell me what Apple traded for in 2003? It's at the very top of the chart on the far left side. You have to look for the years. It says 2003, and then it'll say high and low. I'll give you a hint. It was under $1 at one point during 2003, and now it's today. I think it's 1.2 and something. You guys know how to find stock quotes on your phone? Anybody can get me the quote for today? You go to Yahoo Finance, and it'll have a little spot, and you go in there and you put in the ticker symbol. Apple's ticker symbol is AAPL. So anyway, what the club does is they take all this information and then they put it into the software. So behind the second page is the software program after you print it out. And it tells you, it's got a chart, it tells you how it's moving. Okay. And then you also put in estimates. You put in the estimates that your analysts say they think the stock's going to grow, and it gives you a buy range. It basically tells you, do I buy this stock or do I sell this stock? So the other great thing about an investment club is it does diversify your risk, because you're sharing the risk with all the other people in the club. You each have a portion of the club. It's basically your own mutual fund that you manage. So what I would like to do is it takes at least 5 or 6. It's better if you have 10 or 15 people, because then you share, it takes work, you share the work. Share the costs, it's cheaper for you, it's better, all of that stuff. So I have a potential person who's willing to give us some money to trade with and to buy stocks. You will not necessarily make any of your own money unless you invest your own money. But investing your own money, you need to learn first. So investing your own money would be another step down the road. You'd have to, first of all, show me you've got a budget and that this is your savings portion of your budget. Because you know, you're going to have expenses. You're probably all thinking about college, all that stuff. You're going to have expenses. But it would be a great time for you to learn about stuff. When you go to college, many of the colleges have these investment clubs. So you already know. I know Sonoma State has one. I've heard UCLA has one. So they're prevalent if you go into business. And if you already know a little bit about it, it's pretty awesome. So if you're interested, come talk to me. The second thing, just Twitter's very short history. I'm not recommending you buy either of these stocks. Don't go home and tell your parents that I said for you to buy. You must do your research. You must have the money. You must, okay, it's just like you're learning here. It's all very, a lot of work goes involved. So the second thing, if you're interested, I'm starting the nonprofit that's going to help us get donors to give us the money to invest. I'm looking for interns, and it is a paid internship, and you'll be learning more about money, learning about that kind of stuff. So if you're interested, I'll be here till 6. I'll hang around. You can come talk to me, or if you have questions, If you don't want those little sheets, bring them back to me, because I've been to San Mateo High, and I want to go to, oh, you guys go to Woodside? How many of you guys go to Woodside?
It's a mix of all the schools.
Okay, so few of you. So bring them back to me if you're not, if you're really interested, you want to keep it, by all means, please do.
And we'll put some contact information out to you. Maybe I'll send a follow-up email. So that if anyone wants to join your investment club, you can. Real quickly before we break, on Sunday, there is a session called Time with Robot Science and Math. And it's going to be in this room. It's free. And the Menlo School is going, robotics team is going to be bringing a robot. And you're also going to be able to build your own mini robot and learn how to program it. And they're also going to play some math and science games. So it should be a lot of fun. The youth council is putting it on for free. So it's Sunday from 1 to 3 in this room if you can come. So.
Everybody, please take a moment to fill out your feedback forms, because if you don't, I'll cry. So there you go. And I'm not pretty when I cry, I promise. So just fill out your feedback forms and also your post-test. It was in the packet that you received at the beginning.
Yeah, the post test is at the very bottom of